We're trying to connect demand and supply side in this huge market. This is like trillions of dollars opportunity. If you just open an investment account, even if you're a high net worth individual, you will not see a lot of offering from your broker apart from being able to trade. And we would like that every broker, every private bank has an opportunity to offer and to put on its shelf some exciting investment opportunities that come from private companies.
Mila, thank you so much for joining our Startup Growth podcast. You are the founder of Ameetee. Tell us about Ameetee. What problem are you solving for which customer groups? And most importantly, does this name have any meaning?
Yeah. Sure, Martin. And first of all, appreciate being your guest today. Ameetee is a marketplace. It's an investment marketplace for alternative investments. And before I tell you a little bit more about what Ameetee does and which problem it solves, let me stop at the meaning of the company. We're an Israeli-based startup, so we were looking for a name that would sound nice in Hebrew. And in Hebrew, there is a name, there is a word. Ameetee. It means real or genuine, but originally the way we were picking up the words, we wanted to have a short name, starting preferably with an A, just because this is how people's brain work. You typically remember it faster. We were looking for a word with a meaning in across different languages, and it came so that in Sanskrit, one of the most ancient languages, it means boundless. And this is, a big meaning for us. We really want to delete certain borders or bounds that are out there. And if you provide it in like French manner, like Ameetee, it means friendship. So it's like a multi-meaning word. Turned out to be. So what we do strongly believe that the alternative investments market, private equity, private credit, other assets, it is a very fragmented market. Investment funds that invest in alternative assets, there are multiple companies trying to raise capital. Some of them are more successful, some of them are less successful, some of them are more bankable, others are less bankable. And there is a big universe of people who just invest in the public market. They will probably do that mostly via different financial organizations such as wealth managers, brokers, banks, private banks, or multifamily offices. So there can be many. And one universe on demand side barely means other universe on the supply side. So that's briefly what Ameetee is about. We're trying to connect demand and supply side in this huge market. We do believe that this is like trillions of dollars opportunity, because very often if you just open an investment account, even if you're a high net worth individual, you will not see a lot of offering from your broker apart from being able to trade. And we would like that every broker, every private bank has an opportunity to offer and to put on its shelf some exciting investment opportunities that come from private companies.
So basically, you're giving this kind of white label solution to financial institutions, giving them the platform, and they then are responsible for providing the supply side and demand side to this platform. Or are you trying to also put up supply on this marketplace?
Yeah, let me comment on that. Ameetee is a little bit like, it has a chicken and egg problem, like Uber has with passengers and drivers, right? So first of all, we do believe that white label solution is for financial organizations. So basically what they can do is they can visit the platform, get onboarded, see what is available in terms of different investment opportunities out there, select what they like to distribute or show for their clients, and then we can either white label it for financial institutions, or we can leave it as is. At the same time, if you're representing supply side, so if you're a company that is looking to raise capital, or if you're an early investor who has some secondaries to offer, then you can equally onboard as a seller or as a supply side into the platform and put your deal out there, get it exposed to financial institutions. In between Ameetee stands, we will not allow any deal to go into the platform. just because we do not think that any kind of deal will be accepted by financial institutions. They represent somewhat different client segment than clients of B2C platforms.
Yeah.
We are not a crowdfunding platform, rather we are
Yeah.
information platform. And
Yeah.
for financial institutions, the offering is available in the form of securities, so they can pretty much transact like they do with structured products, or like they transact their over the counter with the bonds. That really simplifies their transacting.
If I'm looking at the private equity market, for example, let's not talk about private debt for now. There are like different private equity or VC investors trying to invest into startup companies, for example, in exchange for equity. And so they are injecting new capital in there. Then there are additional private equity firms, for example, trying to buy out secondaries from employees or founders, so taking money off the table, so to speak. And then, of course, there are bigger companies who want to buy a majority or maybe all of the company. For which segment would you like to focus? Because in the beginning, you would need to focus in order to create liquidity in the market. Because if you have like one secondary deal in there and like two capital raising deals in there, it might be very hard for your platform to create this liquidity. So that's why if you have a two-sided or multi-sided marketplace model, and yours is, from what I've heard so far, is more like a multi-sided, because you have on the one hand side supply, on the other hand the demand, and the third one is even you need to manage the financial institutions because they are acting as an intermediary in your model. So having three different parties with different incentive structures and then designing a win-win-win situation for them, and of course for you, because your business also needs to make money with that, is hard, especially if you are starting out. How are you focusing on creating liquidity in your marketplace? So and you could do this by, for example, only focusing on one specific region, or like, for example, only doing US or only doing secondaries in specific companies or whatever. And if you focus on a specific thing, please tell me, what market inefficiency are you trying to solve? For example, if you're looking at secondaries, there are also lots of buyout funds who are buying secondaries and then trying to sell them to institutional investors, which is also some kind of a two-step marketplace model running through their system. What you propose is more, it seems to me, like an open marketplace, like a stock exchange or something like this, where people then can list their secondaries or maybe investment opportunities, etc. Maybe you pre-qualify them, etc., and then they are routed to the right institutional investors via your financial institution partners. This only works if you're solving some kind of inefficiencies that you've identified. Can you tell me more about that?
First of all, and there are a couple of questions which I heard. One question is, what is our major focus? Yes, we are more looking into technological company space because, first of all, it was, or at least we're focusing on it right now. We do believe that the years of 2022-2023 have brought the valuations back to norm. And there are a lot of companies, they look attractive. I would not necessarily say that we are only looking into secondaries. We are looking into both secondaries and their primary space. And again, given that the universe on the buy side is very different for us, we do have some financial institutions already onboarded, but we also do have family offices. They do have different risk appetite. So I would say that we are concentrated more on the tech space, either late stage or growth stage. For example, back last year, we did a relatively small transaction by helping a startup from the UAE to fundraise from a family office. Most of all, what I think is that people are looking for opportunities that would allow them to make a meaningful return, or the clients of financial institutions. Again, I'll go back to why I think that's the case. And B, not too much risk. Obviously, when you invest in private equity, there is a lot of risk, but there can be much more risk if you invest in early stage startups. And to diversify, definitely it's better to invest into a fund if you're not professional. However, if you see future IPO of the company on certain time horizon, let's say 2, 3, 4 years, if there is much more information available about the companies, and exactly, there are many funds who are looking forward to buy secondaries, but this market is relatively big. It's possible to find their attractive deal opportunities. And yes, financial institutions sometimes will also look for their clients to buy the secondaries, but there is, thousands of financial institutions who do not know how to do it, who will probably be, very comfortable with buying something in the form of security, something that they can easily process because they have been dealing with bonds or with structured products or with other similar things. But at the same time, they will not be feeling very comfortable process-wise with doing a secondary transaction for their client, in which case they will probably refer this client to another platform like B2C platform, or they will refer it to a fund and probably will not be able to, to make any money out of that. So what Ameetee effectively does, it's not just, finding and sourcing great opportunities and doing diligence and verifying that this is a good company and there has prospect for growth, but also we do a repackaging. And it may sound like, to repackage or securitize something is kind of commodity in this market. And it is. But when you combine certain things, like deal sourcing, creating the right data rooms, creating deal materials, and repackaging on top, and they're accommodating in that they're securitized their transaction. So that is kind of a long process, and some large wealth managers can really manage that. They can establish various issuance programs, they can establish whole teams that will be looking and sourcing what's interesting out there, but definitely not everyone. A medium-sized wealth manager will probably never do it.
Based on what you've told me, I think it would be much clearer if you would frame it like a private equity and private debt platform, because this is actually what you're doing. Please walk me through, for example, a tech startup reaching out to you and they want to raise a growth equity round of, let's say, $20 million. And you've checked their financials, metrics, growth plan, everything looks feasible. They also have some good investors already on their balance sheet. Walk me through the process of exactly what you're doing, how you're enabling getting them funded for this like 20 million, and how's your revenue model working, and what are the financial benefits for example, financial institution in that. Just walk me through the economics, so to speak.
Absolutely, happy to do that. So once we understand that this is a great transaction in our view, first of all, we will publish the transaction on the platform. And it will become available for whomever has onboarded as financial institutions there. So they will be able to enter the platform, to look at the data room, to look at the materials. We both have a typically non-confidential and confidential part, and it's possible to sign NDA via the platform and to get everything ready. Once onboarded, their partners have considered that this is a great transaction, they can express their interest straight on the platform, and then the whole settlement will happen outside of the platform. There will be a security created. This security will be, let me put it this way, it will be an equity linked note. So it will be, for example, a note issued by a Luxembourg securitization vehicle, which is compartmentalized, and specifically, all the proceeds from the issuance will go to buy certain asset, in our case, this $20 million gross equity. So if we do have demand and our partners agree with us that this is a great transaction, then the security will be issued and it will be bought outside of the platform. Ameetee doesn't participate in it. At the same time, security will have certain upfront and there is success or performance fee embedded in it. Let's assume for simplicity, 5% upfront and their 10% their performance fee. Financial institutions will typically receive a good portion of the upfront fee to get motivated for their successful distribution of the asset. And this is how they are remunerated. But at the same time, they will also receive a portion of performance fee once the notes are repaid. And they will be repaid either if there is a liquidity event such as an IPO, or if there is secondary sale, etc., etc. Typically, the notes we will issue for 5 years, but it really is transaction specific. So if within 5 years there is no liquidity event, then we will go and look how we can sell down the line asset in the secondary market.
Might there be some kind of a problem? So if you are only limiting this for 5 years, for example, and the startup did not have a liquidity event, did not sell or whatever, or maybe they had some kind of new investment rounds and thereby diluting the equity linked note, how would this work? Are there any potential issues that could arise for a startup going through this process of raising money via your platform?
The security that is ultimately issued is very deal specific. Obviously, if we have a good understanding that the companies will be ready to go public soon, then 5 year time horizon is very reasonable. Typically, if we think that someone is going public, we will typically know that maybe 2-3 years before they really do it, not 5. If this is a growth company, then, really depending on the counterparty, if it's a family office, it can be just a direct transaction, so there is no issue. If there is an issuance based on the gross equity company, then it really has to be very deal specific. Maybe we issue notes for 5 years, but we have an extension option, similarly to what their VC funds do. Or maybe we issue a longer dated note. As for dilution, it really, if it is a minority stake, then typically, like with any other investors, it will be just the same for whether you repackage this transaction or not. It will typically not be protected against any dilution. And they just have, the investors just to have recognized that they're facing certain risk of being diluted. And again, it's not necessarily bad or being diluted if the company goes on and performs well, and is growing in its valuation, and their operations are better and better, then it's a nice problem probably that it continues its successful fundraising efforts.
So dilution is totally a normal game of the play. I'm just checking out whether there are some kind of mechanical issues that might arise, that, for example, something might not be diluted or that it's clear to the startup founders. Okay, now let's assume a startup, they are already reached out by companies like Goldman Sachs or whatever, bigger growth equity funds who are having like 10, 20 billion asset under management, and they are getting calls, emails, at least the good company. Shitty companies, nobody really cares, but the good companies, they already have in their CRM system, love to invest in this company, this company, this company. Now, this founder could directly talk to those investors or raise money via your platform, or maybe just reach out to Goldman Sachs or something else. In what way would your platform be a better way for example, raising primary capital? Would it be, for example, faster closing, higher valuation, maybe some specific deal terms which are more preferable, which other institutional investors typically don't do, or any other benefits? What I'm asking for is, what is the value proposition of your offer compared to the other alternative ways of how a startup could raise money right now?
Martin, first of all, what I would say that even if there are big guys coming in, there is often an ability to participate in the primary round for small investors, or even if there is Goldman Sachs or Morgan Stanley or JP Morgan or some other bulge bracket banks, there is an opportunity either for the secondary or to take some allocation. That's probably one thing to look at it. I wouldn't say that Ameetee, a small startup that is just being developed, is better or can raise funds better than Goldman Sachs, but we can definitely raise a portion of these funds, and it's frequently so happens that their smaller guys are allowed in the primary round. The second consideration is that apart from primary rounds, in good companies there are often secondaries, especially if the company has been growing. There are either management or the shareholders or early investors who are really willing to sell because it's time for them to exit, and it's for them. Ameetee can also be pretty useful as their exit strategy before there is a liquidity event. And again, I wouldn't claim that this platform is better than going and trying to sell via Forge Global. not necessarily, or via other platforms. No, I mean rather that we target somewhat different investor audience. We target such an audience that, you know, didn't have much access or didn't have much chance to buy their financial institutions directly. And this is one of the values that I see there, that we're trying to reach an audience that wasn't there. Well, some of the people were. You can be trading and investing via different platforms, or you can be investing via venture capital funds, but not necessarily everyone. There are many people who do not know that this is a great asset class and you can put some money as a part of your asset allocation into it.
Tell me about the first case studies that you did, because from when I look at your website, it said like you already have like 2 or 3 transactions done. Can you tell me more about that?
Yes. Yeah. Although I will, one transaction was company named Bizat. The company comes from the UAE. It's an HR tech. They are growth stage company. We help them to find an investor for their primary round. The second name, I'm not sure I will be able to disclose, but that was a convertible note. That was a convertible debt, and it was both combination of a little bit. We did a little bit of secondaries back in autumn, and we did a little bit of primary this spring. We're working on a couple of new, very exciting transactions. I'm afraid I will be able to disclose them just a bit later.
Sure. One thing that comes to my mind is more like a positioning question. For example, basically what you're telling me is, Martin, we have a marketplace. From my point of view, Goldman Sachs, Morgan Stanley is also nothing more like a database or marketplace where they have some supply and demand investors matching them, at least for M&A purposes, and thereby taking their fair share. Yeah, they also do the due diligence, the data rooms, etc., etc. Okay, in your case, you are putting even an additional distribution layer on below that. So how you could rethink what you're doing is basically you are also like a modern investment bank doing private equity and private debt, but you have a huge network of other distribution channels, which are basically other financial institutions who are then also, because you are, as you said, you have private equity and private debt, you are trying to securitize that, make it sellable via your platform, either directly to maybe a client that you are working with, or via a distributor or wholesale company, financial institution, who is then selling the security to their clients. And then, of course, they would get some kind of compensation. Why did you decide to position yourself more of like a tech company, marketplace company, and not just a modern fintech investment bank?
Well, Martin, it's a little bit of a semantic question. We are marketplace in a sense that there is an exposition of certain investment opportunities. There is demand side, there is supply side, buy, sell. That's on the one hand. On another hand, we do believe in attaching a technical element or technology element to it, just because definitely we think that there is filtering needed. We have started to work on that. Yeah. Indeed, there is more and more, this is more and more the trend right now to try score, not necessarily based on AI or machine learning, but this can also be a part of the play. But, with private credit, you probably need a simple scoring model. With companies into their late stage, or growth stage, you can probably use some combination of machine learning and their, typical scoring mechanics like filtering. So this is what we will be doing on the platform. But apart from that, I do believe that many companies that are bringing together numerous processes that were not brought together yet, they also bring certain degree of innovation in the industry. It's not necessarily that you have to be super sophisticated, they're AI powered, etc. You need to do your story right. For example, before Starbucks, people were not thinking that a cafe can be something more than something near your house. but it can be in the whole network. And that was an innovation of that time, bringing different parts of that are essential to create a product together. This is also an innovation, and there, in this regard, yes, I do think that we're kind of technology company.
Can you show me, for example, because if I look at your business model, I think at what point does it make lots of fun? Once you are on track on making like $15 billion in transaction value per year, then the fun starts. So, because then if you're doing like 5%, 7% or whatever revenue share, basically for all the work that you're doing, then you're making some good money and maybe have like a $1 billion, $2 billion company valuation. Or tell me, how do you want to grow to, let's say, 100 million, 500 million, $1 billion in annual transaction volume?
Yeah, Martin, I like your big idea about $50 billion per year in turnover. I would say that we have relatively more modest expectations. In 2023, our cross transaction volume was approximately 12 million, but that was the starting year. And again, I didn't mention that in the beginning. In our experience, an average sized broker or wealth manager can probably generate a few dozen $1 million in transaction volume per year if they got interested with the product, if they have understood it, etc., and if they started to distribute it to their clients, and if your deals are right. It really matters what you securitize. You really should be hunting for and sourcing out the best deals, because everyone is willing to make money. So first of all, I do think that it's very realistic to grow from let's say 12 million last year to probably 70-80 million in gross transaction volume this year, maybe to 100. Then it entirely depends on us. How many are active clients who are on board? How happy they are with what we do? How quickly we learn based on their feedback, what they like and what they don't like. Then maybe next year we are able to do much bigger volume than this year, like increase it another 3 times. I'm probably far more conservative than talking about 50 billion, but I do believe that in a few years we were able to grow at gross transaction volume of hundreds of millions of dollars. This is what I do believe as a realistic figure.
This all depends on what type of market segments you would target. I mean, if you would be only targeting like a primary early stage, which you are not, because this is not the right fit for institutional investors, but this might be too little. If you are only doing like primary growth, maybe you can also do only, I don't know, maybe $1 billion or dollars or whatever as a maximum gross transaction volume. I don't know about the market size of secondaries, but I could imagine that it's also quite big. But if you then would be at some point focusing more on the bigger companies. So, I mean, if the securitization process and distribution of securities works, and you would have a partner, really good partners, Morgan Stanley, JP Morgan, etc., distributing the stuff. If you would own the customer relationship, for example, with the CFO of Salesforce or another bigger tech company, and then talk to them and then structure a deal, say, guys, I think we should talk about private debt. Okay, why? Okay, maybe it's because you pay less interest or something like this. And we are fast at closing. We have a really huge network. And then, of course, they would ask, we can already go to the Goldman Sachs. Then, of course, you need to have some kind of argument why you would be providing more value for the specific situation right now. But then you might get like, with one transaction, 500 million or $1 billion in private debt placement, for example. Most likely you would not make like 5 or 10% revenue share on that. There's one thing is gross transaction volume. The other one is like, what is the revenue share that you are taking home for your company? Yeah. But if I would be thinking about like, okay, I would start like only in secondaries, maybe. Again, to me, I would really want to know if you're going to bigger tech companies or the Salesforce of our world and then talk to them, what feedback are they giving you? Because in my world, I would always try to understand, okay, are they cheaper, faster, better? Are they more reliable? Do I have less risk of getting the result that I want, or something like this? Which is all one specific way of how to look at the value proposition. For example, if you look at different financing alternatives, like for example VC money, you you are more likely to get it if you're very early stage because no other investor will go in there, but it's super expensive. Okay, fine. But if you have lots of financial track record already, or you have like hard assets on your balance sheet, you might be able to get cheaper funding, maybe from a bank or something like this. Yeah, okay, but this has some other issues in it as well. So at least then they can do a trade-off. But if you are trying to solve, for example, the issue of selling my secondaries as, I don't know, head of product management at a big tech startup, and my shares are currently valued like 2 million, and I would like to sell off 1 million, because whatever, I want to buy a house. Why should I use your? Because I already got some telephone calls from other secondary shares brokers who are sending me spam emails because they they know that my company is hot, and they have some kind of institutional investors who would love to get my $1 million in this specific company. And then you would need to have some convincing argument. And so far, I did not hear it yet, and I did not see it yet. But would love to learn about how you think about this.
I think that a very big idea is to have a strong backup of those who are interested to distribute our product to the end clients. Yeah. And once that number, there will be a critical mass as we consider it. One that the critical mass is created, then basically we could make as an argument that the network of those to whom we can quickly distribute the product is very large, and it can be done. It doesn't take a lot of time to securitize a deal. It actually can happen very quickly. So that's not a question. So then the argument will be, and as of now, we obviously have to think into the future a little bit, and we're dreaming of that moment to come. So first of all, it will be a large base of clients who are interested to come in one security issue and can do it quickly. So these will be the arguments going forward. For financial institution, it will be an argument of, going into really attractive deals very quickly. If they are onboarded on the platform, if they can quickly get the access to the information, if they can quickly show it to their clients, then I don't see why won't they be able to do that. These will be the main arguments. And they're also going forward. We do have a very strong desire to create better liquidity in this market, because to sell a small portion of equity in the late stage company can be very problematic. You need to find an investor. You typically will need to pass all the corporate approvals, etc., etc. It's not necessarily easy. If you want to sell only a small amount, then it will be potentially difficult for the company to agree, or for investor to buy, etc. So what is also the end point that can make the platform attractive is that when you securitize private equity transactions, it's technically much easier to do secondary market transactions. This does not per se create liquidity in the underlying asset, but this at least creates a base for better liquidity in the underlying asset. And that is also a very big plus to those who have already invested.
I totally agree. I mean, at some point, you are just starting to be a competitor of the big stock exchange, NYSE, or whatever, because you're first trying to get earlier into a company which is currently not doing the securitization. This is also how you could view it. Yeah, for example, I mean, NYSE, if they were smart and fast, whatever, they could basically do the same. I don't know the market well enough, but it seems to me like they are not doing that. And so that's why there's no opportunity for you to securitize those type of private equity and debt instruments. And then at some point, if you have enough liquidity in your market, you can also not only do the primary transactions, but also the secondaries. And then you basically have like two revenue streams, like the primary revenue stream, and then like like a normal stock exchange would have on a per transaction basis as well.
Yeah, but Martin, I do not necessarily, think that this is what is turning your Ameetee in exchange in the future. There are certain markets that remain semi-liquid, and I would not expect this market to be, as liquid as the public equities. Most likely not,
Okay.
because first of all, this kind of investors, they will be available typically for the professional or for qualified investors, those who can accept this level of risk. Second, we have different examples, like there is a syndicated loan market. Is it liquid? Yes, more or less it is. At least it's much more liquid than just the loan market. When you have lent someone money as a bank, and you have to wait until maturity, the syndicated loan market there has its own quotes, and it's possible to do something in it. Is it traded on exchange? No, it's completely traded between banks, and there are other professional market players who can participate in the credit process. Here, I would skew towards this kind of market. So it will probably remain OTC, not very liquid, but better liquid than it is now. And definitely it will be a plus. Otherwise,
Okay.
the company goes public and it becomes liquid.
And if you look at your company, what are the top 3 challenges right now that could kill or break your company? So if you are not solving those 3 things, then your company would be dead in like 1 year or so.
I would say that the most important thing for us is to ensure that we have enough distribution partners. We have some, and we deliver them a stable flow of exciting transactions that they really, want to distribute and successfully do. So that's, I wouldn't necessarily say that if we don't find enough, that will kill us, but it probably will, make me and my co-founders ask ourselves whether we're doing the right thing. And despite we really believe in our idea, I also tend not to be too egocentric about my ideas. I can be wrong sometimes, of course, like any other person. And the feedback will either prove that we're moving into the right direction or will not.
How did you come up with this idea? And was there some kind of triggering event or something like this where you have this eureka moment where you said like, why didn't nobody solve this problem already? Or why didn't nobody solve this problem in this specific way?
It started quite a bit of time ago when, like years ago, when I and my co-founders, we have known each other for many years, when we have started to invest in startups as angel investors. We had been bankers by that time, and we knew how public markets work, and there were investing there as well. But here we started to invest as angel investors, and after you have invested as an angel, typically you are excited at first. Then you understand that it's a very long story, not always successful. In quite a big number of cases, it's not successful. But sometimes it is. Still, you have a very long way to go. So it's interesting to look at later stage companies. But for later stage companies, we didn't have sufficient checks ourselves, like to be able to invest as individuals. So we were trying to look here and there what's available, and there wasn't much.
Your story right now reminds me at another type of company. For example, I don't know the names of those right now out of my head, but they have the story of like they are top tier VC funds, and right now only accredited institutional investors can invest in them. And there are top tier funds who are making like 20%, 30% annual return on invested capital, and you don't have access to that. We will change it. This is the problem what we are helping you solve. We are giving you access to this top tier funds, which normally you would not be able to do there. If you are a doctor or a partner at a management consulting company or whatever, if you have like 200,000, 400,000 US dollars in liquid capital, you would like to invest in those type of funds, we can give you access. And this is basically what they did. What you just told me sounds to me very similar, but not on a fund of funds type of level, but more on a direct investment level or on a secondary level. So if for example, somebody wants to sell secondaries or something like this, which then you could use to change your positioning and say like, what problem are you solving? We are enabling you access as, I don't know, a doctor, management consultant, whatever, to actually be able to invest in the Snapchats, Facebooks, whatever on this world, which are in the private market via Facebook. And then basically try to learn from the playbooks that those fund-to-fund companies are doing, because from my understanding, they are using like community building, group building, offline events, etc., to get those people like the 100K, 500K type of people in there, and then have them write tickets to them so they invest into Kleine Perkins, Sequoia, etc.
I think that you are probably talking about Moonfair. There is a platform.
Yeah.
And they're doing a great job indeed. Yeah, I do agree. Look, at the same time, people can be interested in investing in funds in smaller chunks or just have access to them. They can equally be interested. Their funds is very nice, and they give you diversification and many other things. It can be a long process. It can be a longer process than investing on a deal by deal basis, picking up or some really nice opportunities at later stage. Deal by deal basis also enables you to look at various credit related transactions. It doesn't stop Ameetee from marketing some good funds. We don't have this as immediate goal, but we really also like fund investments was the focus on their single name, primary, secondary at later stage.